Every year, trillions of dollars flow silently from corporations to ordinary investors. Not to Wall Street, not to hedge funds, to everyday people who discovered a simple mechanism. A machine that keeps paying you, regardless of what the market does. Most investors focus on price. They watch the market, check their phones constantly, and try to buy low and sell high. And the vast majority fail to beat the simple index fund. Why? Because they are playing a guessing game, trying to predict the future of a stock price. Human beings are notoriously bad at predicting the future. The smartest investors figured this out decades ago. Don't bet on price. Bet on cash flow, specifically dividends. A dividend is a cash payment that a company makes directly to its shareholders. When a profitable business has excess cash, it can reinvest it, buy back shares, or distribute it directly to owners. Dividend companies choose to share the wealth, and they do it every quarter, year after year. The numbers behind this are staggering. Since 1926, dividends have accounted for roughly 40% of the total return of the S&P 500. Not capital gains, dividends. Think about that. Nearly half of every dollar made in the stock market over the past century came from simple cash payments, not from buying low and selling high. That single statistic should completely change how you think about investing. The vast majority of long-term wealth in the stock market was not built by traders. It was built by patient investors who collected dividends and reinvested them over and over again. And the mechanism that makes this work is one of the oldest forces in finance, compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he said it or not, the math is undeniable. Imagine you invest $10,000 into a dividend-paying portfolio yielding 4% annually. In year one, you earn $400 in dividends. You reinvest them. Now you have $10,400 earning dividends, and the cycle begins. Year after year, the base grows, your dividends earn dividends. In 10 years, that original $10,000 has grown to roughly $14,800, even if the stock price never changed. Not because you did anything clever, just because you let the machine run. In 20 years, it is over $21,000. In 30 years, over $32,000. Now add $100 per month in new contributions. After 30 years, you would have over $180,000 from just $10,000 initial investment plus modest monthly contributions. That is the compounding machine in action. This is why dividend investors do not panic when the market drops. A falling price on a dividend stock means you can buy more shares at a lower cost. More shares means more dividends. More dividends means more shares. The machine accelerates in downturns. This is called a dividend reinvestment plan, a DRIP. Most brokerages offer this automatically. When your dividend arrives, instead of going to cash, it immediately buys more shares. You set it up once, you never think about it again. The machine runs completely on its own. And here's what separates DRIP investors from everyone else. They actually love bear markets. Every crash is a sale. Every dip is an opportunity to buy more of the machine at a discount. Not all dividends are created equal. The real elite are called dividend aristocrats. These are S&P 500 companies that have not just paid dividends, but increased them every single year for at least 25 consecutive years. Let that sink in. Through the dot-com crash, through 2008, through the pandemic, these companies kept paying, and they kept raising the payment. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, Automatic Data Processing. These are not exciting, flashy tech stocks. They're often called boring, and that is precisely the point. Boring businesses that generate consistent cash flows year after year, decade after decade. When you invest in a dividend aristocrat, you are buying into a proven cash-generating machine, not a speculative bet. Coca-Cola has paid dividends since 1893. 1893. That is over 130 years of uninterrupted cash payments to shareholders. The CEO who cuts that dividend puts their career at serious risk. These companies treat the dividend as almost sacred. It is not just a payment, it is a signal to the world that the business is healthy and confident. The average dividend aristocrat has increased its dividend by about 8% per year over the past decade. At that rate, your income from dividends doubles every 9 years without you adding a single dollar to your investment. The companies do the work. You collect the reward. That is the deal, and it is a deal that has outperformed most active trading strategies over any long time horizon. So how do you actually build one of these portfolios? Start simple. You do not need to pick individual stocks right away. The Dividend Aristocrats ETF, ticker NOBL, gives you instant exposure to all 67 current Dividend Aristocrats in a single purchase. One fund, instant diversification across 6 decades of dividend-raising companies. Another popular choice is the Vanguard Dividend Appreciation ETF, ticker VIG, which tracks companies with a 10-year record of raising dividends. And for higher yield today, SCHD, the Schwab U.S. Dividend Equity ETF, has become one of the most talked about funds in the dividend community, offering a 4 to 5% yield with strong underlying fundamentals and an excellent track record. Once you are comfortable, you can add individual dividend aristocrats to your portfolio. Look for 4 key things: a payout ratio below 60%, a dividend growth rate of at least 5% annually, strong free cash flow, and a business in a sector you understand. The goal is not to maximize your yield today. It is to maximize your income growth over time. A growing dividend always beats a high static one. Here is the final advantage of dividend investing that rarely gets discussed. It makes you a better investor psychologically. When the market crashed 50% in 2008, dividend investors kept receiving the same checks they always had. Their income did not go to zero. While most investors panic sold at the bottom, dividend investors bought more shares at historic discounts, and they were rewarded enormously in the decade that followed. Dividends anchor you to fundamentals. They remind you that behind every ticker symbol is a real business generating real cash for real owners. The dividend machine is patient. It is boring by design, and it has built more wealth for ordinary investors than any other strategy in history. If this video opened your eyes to the power of dividends, hit subscribe. Every week we go deep on the strategies that actually build wealth. The next video is waiting for you right now.